My name is John Fung, and I'm a registered chartered accountant in Canada and Australia. I currently work at William Buck in the Business Advisory Division, specializing in international tax. I also act as the Secretary of the SME Committee for the Canadian-Australian Chamber of Commerce. The CACC's mission is to promote trade and investment between Australia and Canada, and the SME Committee's focus is to help small to medium enterprises expand globally. I think the first thing that most businesses really need to focus on is the where. Overseas expansion, there's a lot of different places that you can go to. Now, if you're focusing on Canada, even within just one country, there's different provinces that have different laws and different restrictions that you have to consider. That's kind of beyond accounting, so I'm just going to focus on kind of the accounting side. From an accounting perspective, probably the first thing you're going to have to do is look at whether you're setting up a subsidiary or a branch. Now, a subsidiary is a company that will operate in that country and wholly owned by the Australian entity or whatever entity you happen to be having domestically. Whereas a branch actually is a part of that company that operates in that country. These are two very different setups, and they have different reasons on why you would do them. So a branch, usually one of the main reasons that you're going to set up a branch is the licensing that goes with your head company. So one of the best examples I've seen for setting up a branch was a head company had licensing registrations for financial reasons within their home country, and that was grandfathered in to the country that they were moving to. What this meant was they didn't have to do all the compliance and other regulations that sit within that certain requirement for that license, and saves them a lot of time. Now, a subsidiary is definitely the most common one that's opened up. It's a wholly owned company. It splits out a lot of liability. So with a branch, normally you have this thing called permanent establishment, which theoretically means, well, what income actually belongs in that country. A subsidiary, that's completely separated, and it's not going to bring in the profits that your host country would normally have, which definitely is a bonus. Another great benefit of subsidiaries is that they'll actually act on their own within that country, which makes the registration process much simpler. Probably the top things that you really have to consider are all of the other registrations that go beyond just registering a company. Now, these include all your payroll obligations, VAT, GST is a great example, where it's quite different depending on the jurisdictions that you sit in. And there's a lot of different legal requirements that go with it. For example, here in Australia, if you were to move coming into Australia, there's payroll requirements that sit within the Australian Tax Office, as well as a component called superannuation, which is a 9.5% additional cost that you have to pay your employees that you don't really see in Canada. It's not like a CPP, or is it like an RRSP? So GST, or VAT as it's commonly called in most other countries, GST in Canada and Australia, is quite complex depending on where you're setting up, as I mentioned before. So a great example of this is in Canada, every single province has two different types of sales tax normally. This is GST, which is the federal tax, and PST, which is a provincial tax, and they both require different registrations. There's also a third tax called harmonized sales tax, where they combine those just to make it slightly more confusing. This can be found, and it varies considerably from province to province. Probably one of the most forgotten registrations is not a registration per se, but setting up a bank account. These days, it's a lot more difficult to set up a bank account than you would normally think. What with the anti-money laundering and anti-terrorism laws that came in, banks have this know your client requirement that makes it so they have to do a lot of different ID checks. If your structure is relatively complex, this can mean that you need a lot of documentation that you wouldn't normally think you would need. This includes certificates of incorporation, different IDs for both shareholders and other controlling items. It becomes quite complex, and unless you really know what you're doing, it can take a very, very long time to set up. One of the most important things to consider from an accounting perspective when moving overseas is the concept of transfer pricing. Now, what transfer pricing is basically is the amount of profit that's going to be left in a country that you're moving to. And it's a formal agreement kind of showcasing this. There are many types of transfer pricing arrangements that can be made. Some of the more common ones will include a sales hub and marketing, where what you're doing in that foreign country is really having a team that is building contracts that are going to be held within your home country. And another common one would probably be a distributor model. So if you are manufacturing goods, say, here, and then you're shipping them over to a different country, to your other company to sell onwards, there's going to be a certain percentage of profit that you're going to have to put between them. And so your margins are going to move depending on what it is. These are really important to establish because there's quite a large focus globally on this concept of profit shifting between country to country. And all of the taxation offices that you're running into are really taking a hard look at it these days. Everyone's experience when moving overseas can be quite different. I'm sure there's a couple questions you might have that we didn't address in this video. If you do have any questions, feel free to contact me at the address below.